Welcome to Thinking Devils. What does it take to buy one of the biggest football clubs in the world? A fortune, a master plan, a passion for the game, or just a willingness to borrow someone else's money and ride the tiger of global capitalism straight into the heart of English football? Welcome to the story of how Manchester United, the People's Club, became the pawn of a leveraged buyout. This is not just a tale of numbers and contracts. It's a story of naivety, hubris, opportunism, and one very determined family from Florida. It starts in the late 1990s, with a club at the top of the world and shareholders wondering what on earth could possibly go wrong. By the turn of the millennium, Manchester United were not just a football team. They were a global brand, a cultural juggernaut, and crucially, they were a public company listed on the London Stock Exchange with quarterly earnings calls and shareholders who read balance sheets instead of back pages. They were leading the Premier League in commercial revenue, pioneering sponsorship deals and global partnerships. And yet, for all their commercial dominance in the domestic game, they were still not a particularly efficient operation by global standards, a sleek-looking Ferrari, but with a 1-litre engine under the hood. In theory, this made United more accountable. In practice, it made them vulnerable. Public companies are exposed to the whims of the market, and once your shares are public, pretty much anyone can buy them. There are no loyalty tests, no background checks, no patriotic vetting procedures. Sky tried to buy the club once, but were blocked by competition authorities due to their position as the main broadcaster of Premier League football. But for most people, if you have the money and the appetite, no one can stop you. And Manchester United, by virtue of being wildly successful, were a very tempting morsel. Steady revenues, strong fan base, next to no debt. Like a corner shop with a cash drawer left open. Irresistible. Meanwhile, in Tampa, Florida, Malcolm Glazer was looking for his next move. He was not a football man. He was a businessman. He had made his money in trailer parks, cheap real estate, and eventually the NFL, specifically the Tampa Bay Buccaneers. And unlike many absentee sports owners, he'd actually had some success there. Under his ownership, the Bucs won their first Super Bowl in 2003, shedding their status as league punchline. He also oversaw substantial revenue growth at the Buccaneers, mainly by improving stadium sponsorship deals, local broadcasting rights, and fan engagement. But the NFL, though financially sophisticated, remains a closed domestic system. With United, the Glazers saw a chance to replicate and vastly expand that model on a global scale. His style was simple: find underpriced assets, borrow to the hilt, and squeeze value. He liked control. He liked leverage. He liked owning things other people thought were untouchable. He had already had a crack at buying Harley-Davidson. In 2003, he began quietly buying shares in Manchester United. A few percent here, a few percent there. Nobody paid much attention at first. A foreign investor dabbling in English football. How quaint. By the time anyone noticed, Glazer had quietly amassed over 15% of the club's shares, a stake large enough to raise eyebrows. As he edged towards 20%, the alarms truly began to ring. According to the UK Takeover Code, once a shareholder hits 30%, they are required to make a mandatory offer for the entire company at the best price they had already paid, so all of the club would be in play. Glazer knew the rules and played the margins expertly. The club's board began to get nervous. Meetings were held. Resistance was discussed. But the structure of a public company doesn't lend itself to heroic stands. Shareholders want returns, not romance. And Glazer was offering a premium. He made his first attempt at a full takeover in October 2004. To be fair, not everyone on the board welcomed Glazer with open arms. In fact, the board initially refused to recommend his offer to shareholders, citing concerns about the level of debt and the long-term implications for the club. It looked like they were holding their nerve when he came back again in February 2005, but they had to accept he was a serious potential buyer and grant access to their internal books. Sentiment only goes so far when you're dealing with public markets. Glazer was delayed but not deterred and remained on the lookout for willing sellers. Critically, in May 2005 he persuaded major shareholder Cubic Expression to sell to him. This holding of 28.7% unlocked the takeover. The businessmen behind Cubic Expression, John Manier and J.P. McManus, had fallen out with Sir Alex over ownership of the legendary racehorse Rock of Gibraltar and Glazer Pounce. This took him to almost 60% of the club, and things were beginning to look inevitable. The takeover code was triggered, and a formal offer was prepared on which the board had to comment. The board had to concede that in purely financial terms the offer was at a fair price for the shareholders. After all, it wasn't the club that benefited from the deal. It was the public shareholders cashing out at a premium. Even after Glazer had picked up his first few small holdings on the market, none of the major shareholders had to sell to him if they didn't want to. But it was no longer about heritage or passion. It was all about politics, share prices, and majorities. The dominoes began to fall. The bigger remaining shareholders decided to sell, and Glazer was quickly up to 75% of the club. When Glazer crossed the 75% threshold, it was game over. The public listing was cancelled. Manchester United, once a community of shareholders, was now a private family business. The Glazers had arrived, and they weren't going anywhere. Eventually, despite continuing to protest about the amount of debt involved, and the lack of any assurances about future ticket pricing or player investment, the board announced that they were all selling their own shares and couldn't recommend that any other shareholder stayed behind. Half of them resigned and walked away. The fans were apoplectic. Protests erupted. The now iconic green and gold scarves, the colours of Newton Heath, United's original incarnation, began to appear in the stands. A splinter group formed a breakaway club, FC United of Manchester. The message was clear. This wasn't just a business deal. This was a betrayal. This was not the United they grew up with. It wasn't even the corporate behemoth of the 90s. This was a leveraged asset to be exploited. For years, the relationship between owners and fans has been one of mutual contempt. We'll delve into the financing structure and how it was probably supposed to pan out in our next episode, but the short version is that the Glazer family raised about £790 million to buy the club, but only put up about £270 million themselves. The rest, borrowed from US hedge funds, not known for their easygoing nature. And crucially, much of that debt was going to be loaded onto the club itself. Manchester United, once debt-free, would become the proud owner of a colossal mortgage it hadn't asked for. But this begs the question, why would a man with no interest in football, from a country where the sport was barely on the radar, want to own Manchester United? The answer is depressingly simple. It made financial sense. United was already a cash-generating machine, match-day revenue, commercial deals, TV rights. The club was ahead of the domestic game. But the Glazers, having turned a regional NFL franchise into a Super Bowl winner in a minority sport, must have seen an even bigger opportunity in football, a truly global game with untapped commercial frontiers. If they could generate serious income from the Buccaneers, what could they unlock with Manchester United? They couldn't believe that the Bucs were generating more commercial revenue in Florida alone than United were from the whole planet. The Glazers didn't need to understand the offside law. They just needed to understand cash flow and global scale. This might have been vaguely tolerable if the club's performances on the pitch had been going from strength to strength over the years. But as we all know, since Sir Alex retired, the club has been a laughingstock. In fact, Sir Alex's genius had masked years of mismanagement elsewhere in the organisation, and without him the wheels have been coming off in comical style. So, what were the Glazers thinking? Part of the answer is, they were thinking like financiers. They saw a profitable asset, already lucrative, but with huge untapped potential, and moved to acquire it with minimal exposure and maximum upside. But leveraged buyouts are supposed to be temporary. The textbook move is to tighten the belt, boost revenues, refinance the debt on better terms once the numbers look healthier, then either float the company or sell it on at a profit. Unless you get too attached or too dysfunctional to execute the final step. And here we are, 2 decades later. The Glazers still own the majority of the club. The debt has been tweaked, has risen a bit and fallen a bit, but is still there. The fans are still furious. So again we ask, what were the Glazers thinking? We fear that they didn't actually think things all the way through at all. Next time, we'll dig into how leveraged buyouts are supposed to work. We'll visit the world of barbarians at the gate, and how this might have worked at United, and ask the most important question of all: why haven't they left? We are the Thinking Devils. If you enjoyed this, don't forget to like, subscribe, and send it to the last person who said this squad could challenge. See you next time.